Alright, so welcome to today's lesson where we are going to look at the effect of tax, the type of tax, the effect of tax on the supply curve and the type of tax. And then we will also look at how it will affect our supply curve. And we also look at what we call a dead weight loss. Dead weight loss. Alright. So tax are being imposed by government on one particular group of people, that is what produces. When it comes to what? The consumption of goods and services, because when you are going to buy, you pay what we call an indirect tax or an excise what? Tax for goods and services what? Tax. If that's the case, anytime there is an imposition of tax and there's a demand equation and there is a demand function and then there's a supply function, the function to be affected is the supply function because it is the producer that determines the price of a particular product. And in the determination of that particular selling price, a component of the tax is supposed to be added. Unless otherwise stated in the question that the particular tax being given or being proposed is affecting the demand curve, then all tax should affect the supply curve. Remember that the selling price is made up of the profit of the firm, and this profit is what the tax is affecting, plus our cost price. So if you want to say, or if you want to determine the selling price in critical terms, is the selling price is going to be the profit less tax component before we add our cost price. Why are we less tax? Because this amount is going to what? To the government. One main source of income to the government is tax. But in this case, the type of tax that will be imposed on the supply curve or the producer determines how you should treat it. So if that's the case, let's assume that, if that's the case, then we have two types of tax. We have the Ad-valerom tax. The first one is Ad-valerom tax, and then the second one will be the value tax. Now, if it is an Ad-valerom tax, then this always comes in what? Percentages. Remember that Ad-valerom tax is always what? A tax given in percentage. For instance, it said the government imposed 25% tax on what produces. But when it comes to value, you will get it in value. Maybe $1 tax is imposed, $10 tax is imposed. It comes in what? In value when it comes to what? The value tax. Now, depending on the type of tax you are given and how it's going to affect our supply function. So in this case, assuming we are having a supply function to be negative 10 minus what? 2p, plus 2p. Then if it is a Ad-valerom tax, in other words, assuming we are having a supply function to be negative a plus our bp, then if it is an Ad-valerom tax, then our new supply function after tax, because we are supposed to get the supply function first after tax before you come and find the equivalent price and quantity after tax, because you are supposed to get the quantity first before you equate it to the demand function. So if it is Ad-valerom tax, then our quantity or supply function is going to be the A, which is the intercept negative, plus B all into brackets, P minus TP. This is when we are dealing with Ad-valerom tax. Then we are supposed to expand the bracket. We are going to have negative A plus BP minus what? BTP. BTP. This is more complicated when you are dealing with your variables. Let's change the value. So in this case, we are going to get QS is equal to negative 10 plus what? 2P into bracket minus what? Let's say the tax is 25%, then 0.25P. So in this case, you can substitute and get your new supply function. This is the case when it is an Ad-valerom tax. what happens when it is a value tax? When it's a value tax, then our supply function after tax is going to be the negative A, which is the intercept, plus our slope, then into bracket the price minus tax. This is when it is a value tax. So this T here is the tax. When it is a value tax, this is the function we use. If it is Ad-valerom, then we are going to use this function. That is the main. So therefore, if you are dealing with this function here, we are going to have our negative 10 plus 2 into bracket the P minus what? Let's say it is 10 minus 10. So we expand it to get your new supply curve. Now, how does this tax imposition affect our consumer surplus and affect our producer surplus? And then what does the imposition of tax lead to? So let's look at it on the diagram. So assuming that this is our initial or our original supply function, which is our QX negative 10 plus 2P, and we have our QD, the previous one, 10 minus what? 2P, or 10 minus P. So let's plot this one on the graph sheet. So we are going to have our graph sheets to this. So we have our quantity here, and then our price here. Let's say this is our supply curve. Remember, this is our supply curve original from this diagram. And this is our original demand curve. So at this point, we are having our equilibrium point. Remember that this point becomes our producer surplus, consumer surplus, and this side becomes our producer surplus. If you don't know what is a surplus, go to our previous video. There is an explanation of what is consumer surplus and how to determine all the surpluses with the equation. Now, assuming there is an imposition of tax in this scenario, if there's an imposition of tax, it will lead to a decrease in quantity supply. It will lead to a decrease in quantity supply because there is a tax coming which is going to decrease the quantity of supply. So anytime there is a quantity supply, you will see a shift in our supply curve. So if there is an imposition of tax, let's assume that there is an imposition of our tax, it will lead to a decrease in our supply curve. So if assuming this is our original, this place will be negative 10, and then this place will be 5. So there will be decrease. Imposition of tax will lead to a shift of our supply curve to move upward. In other words, decrease in the supply quantity. So in this case, we are going to have our new supply curve here, which will be, this is going to be supply after tax. This is going to be our supply curve after tax. So there is a supply after tax. Now what is happening? Now our new equilibrium quantity will be established here. Our new equilibrium quantity will be established here. But remember that, so now this will be our new quantity supply. This will be the new quantity supply. Then remember that this is the previous one and this is the new one. Then currently that will be the quantity supply. So now our consumer surplus will decrease by this amount. So now we will have our new consumer surplus to be here, and then we will have our new producer surplus to be where? To be what? To be this one because of the change or because of the tax. Don't be confused. So this place will now be our new consumer surplus, and from here, remember this is the new the tax surplus. After the tax, this is our curve. So this place, all this place becomes the producer surplus. What you can see is that the consumer surplus is decreasing because the reason is that the goods are being sold. Which people are the final consumption of the goods is the consumers. They pay the tax. So when anytime you undertake purchases of goods and services, you will pay an amount of excise tax on that goods and services. That's why you are seeing this decrement in their consumer surplus. Then this region here, which does not belong to anybody, is what we call the deadweight loss. this particular reading here does not go to anybody. This reading from here to here does not go to what? To anybody. This reading here is what we call the deadweight loss. It is a portion, and this is being created after the imposition of a tax, which does not go to the producer or the consumer, neither what the government. So that is what the deadweight loss. So that is about what the effect of what tax on the supply curve. And then from here you can see that you have what this is consumer surplus after tax, and this is producer surplus after tax. Because initially, when there was no tax, our consumer surplus was this one, and after the imposition of tax, look at what has happened to our various tax. So this is consumer surplus after tax, producer surplus after tax. So this is the effect of tax on the supply. Remember that the type of tax given depends on the function you are supposed to use. But in either cases, our supply curve will always shift to the right, or upward, which means what there's a decrease in the supply of goods and services. Thank you. Thank you for watching our video. Please don't forget to subscribe to our channel for more of such valuable content on all business related courses.